Here, we're going to talk about option pricing again, which means figuring out the fair price to pay for an option. And specifically, we're going to use a method for figuring out the fair price to pay for an option. That method is called the Black-Scholes-Merton method, oftentimes just called the Black-Scholes method for pricing options. So this method relies on some assumptions. It uses the idea of no arbitrage to figure out what the optimal price should be paid for an option. The no arbitrage method essentially means valuing options as if there were no profitable opportunities in which you could earn a profit but take zero risk. And these are the types of strategies that a market maker in an option market would undergo. Basically, the idea is that, if you have a stock and you have an option written on it, you can trade an option, you can sell an option to someone else, and you can actually eliminate the risk from selling that option by constantly trading in the underlying, constantly trading in the stock itself. For example, if you had a stock, you owned it, you could write a call option. You could write means to sell a call option, and you wouldn't actually have any risk per se because you owned the underlying asset. And so if the call became more valuable because the stock rose, that's fine because you own that stock. And so if you size these two positions correctly, you're not really at risk. If the call gets exercised, that stock that you own gets delivered as part of that call. But you're not really out of pocket any additional dollars. This is kind of the idea. Market makers are consistently trading in the underlying asset, as well as calls and puts, and also risk-free bonds. And they are financing these positions that they've got from selling these options, but also from using borrowed money to actually hold the position in the underlying security. And if they sort of juggle these correctly, they can actually make a profit without putting up their own money and without taking any risk. And that concept, not your own money and taking zero risk, is called arbitrage. So arbitrage strategies are really nice. You can imagine the appeal of something like that. And that's why we figure out the prices of options when we use no arbitrage techniques. The prices of options are determined by figuring out what the price should be if no arbitrage existed in the market. Because if arbitrage did exist, we can assume that these market makers, of which there are many out there actively trading day-to-day in options, would immediately seize that opportunity to collect a profit. And that in itself, that activity, pushes the prices and the relationships between these two prices into a certain balance. So what we're doing with no arbitrage pricing is relying on market forces to keep prices more or less in line. And if they are more or less in line, then the prices for these calls and puts will obey some specific formulae. If you recall, one of those formula was that coming from put-call parity. And this was the idea that if you knew the price of the put and the price of the underlying, the price of, say, the stock, you could figure out the price of the call given a particular strike, and vice versa. You could figure out the price of a put if you knew the price of the call and the underlying in the strike. So for example, the price of the call could be found by looking at the price of the underlying and subtracting out the strike price, but of course discounting the strike price to the present value to today, because the strike is the value at which you can convert underlying shares from the option into underlying shares at the time at expiration. So you have to discount the value of that back to today to figure out what the call is worth today. But that can be done by standard present value discounting, the 1 plus r to the t. And the point with put call parity is that you find the call given these unknowns that you then plug in, because they are known. You observe the price of the put, the price of the stock, and the strike for the option. Then you can figure out the price of the call given this particular strike here. So it's kind of plug and play. You know these, and so therefore you can find that. And without going into too much theoretical detail, there were some folks that kind of figured out or applied this concept of plug and play. Well, if you know this, you can figure out what this is on the basis of if there was an imbalance between this and this, there would be an opportunity to make a profit risk-free, and assuming away transaction costs and some other kind of minor details. But they use this idea, this no arbitrage idea, and solving for these unknowns to come up with this formula for pricing options. And that was the Black-Scholes option pricing model, or the Black-Scholes-Merton option pricing model. And the Black-Scholes model for pricing options, for figuring out the prices of calls and puts, is probably the most commonly used method for pricing options. There are variants of the Black-Scholes model, many actually variants, to account for sort of different ideas about how option prices behave, such as something called jump risk, which is kind of beyond scope at the moment, but if you're curious, that's the thing to Google. But Black-Scholes has been around for some time, and it's so ubiquitous because it tends to work and it tends to make so much sense. So let's take a look at it, break it down. So this is the actual formula, and you can see there's equal signs here, and what we're doing is pricing a call and a put given a bunch of information, and this is information going into this. So let's look at this just step by step. First, we see the price of a call and the price of a put is determined by a few different things. If you look at just the call for the moment and scratch out this and scratch out that, then you see a pattern, something you've seen previously. The price of the call is based on how much the underlying ends up moving above the strike, because a call is profitable if we can buy at the strike and then sell at this higher underlying. If the stock moves above the strike, then we profit the difference between the two. That's the profit on this call. And the one thing, as we just mentioned, we have to just discount the strike by the fact that we aren't going to be able to do this until expiration. So the strike isn't the strike today. We're pricing the call today, but the strike has to be discounted because we can't actually do this until sometime in the future. So because of this minus r here, that means that we can that this thing here is exactly the same thing as rewriting it like this, putting it on the denominator here. And if you're familiar with the present value formula, this is how we discount some dollars in the future. We discount it by some interest rate r for that time period t. If you're not familiar with this, you can look at the present value formula separately. It's a financial concept. If you need to refresh yourself, you can. There's a lot of material out there to revisit it with. But the point is that this is just a necessary thing. We know how far away to maturity it is, so we know T because we know the expiration of this option that we're pricing. And then R here is the discount rate, the risk-free rate, the rate on short-term treasuries. So it's kind of like you've seen before. You have essentially S minus X, the profit on this call, discounted. The one thing that changes are these two numbers, the ND1 and the ND2. And these relate to probability. N here stands for a normal distribution. Normal distribution means that, like, if you had a range of outcomes, say for the stock price, it can be any number of things. The stock price in a year can be any number of things. It can be, maybe up by 20%. It can maybe be down by 20%. This normal distribution describes the likelihood of outcomes within that range. And so you can see most likely for this stock, it's just an example, probably most of the occurrences, the highest probability is that it's within this range here. But with relatively less probability, but still possible, it could be even larger. The stock price could move up by a larger amount or move down by a larger amount. That's what this normal distribution describes. And the normal distribution is a function. It's something that's going into this formula here to quantify the uncertainty about where the stock price is going to end up in the future. And so if we look at D1, tracing that down to here, we see a number of things. And really what it's saying is that where the stock price ends up, first of all, it matters where the stock price is relative to the strike price of the option. I mean, if you have a current underlying price that's closer to the strike, then it's more likely that the option ends up profitable than if it were, say, way far away from that. But also, and perhaps more importantly, it depends on the standard deviation of the stock, the risk of the stock. Because, as we kind of discussed previously, a stock can take a certain range, and that's quantified, that range of likely outcomes is quantified by the standard deviation. That's sigma here. And so if you have a stock with higher standard deviation, you have a greater range of outcomes that it can take. And remember, when it comes to option trading, you get the upside, you get all the upside that you want, but you can walk away from the downside. You can cap your risk with an option. You're out your premium, but no more than that. And so higher standard deviation stocks or underlyings tend to be more valuable because it gives you more of the upside and no additional increase in downside. That's why the standard deviation of the stock is an important feature in the pricing of the call option and the put option in this Black-Scholes model. In fact, it's like really the key element. We account for the difference, the distance in underlying relative to strike, and we account for the time to maturity. I mean, the longer an option is to expiration, the more valuable it is because there's simply more things that can happen. But the key thing is this standard deviation. So what we do when we get this number, or when we do this D1 calculation, we ultimately get one number from it. And for reasons of mathematics and statistics, that number can be plugged into here, say 1.65, and we can check this number against, a number that we get from something called a normal distribution table. In practice, what's going to happen is that you can use a formula that's automatically built for you in Excel or in whatever program you use to do this calculation for you. It's like the difference between using a statistics package and, going back to your statistics textbook, if you recall taking a statistics class from some time ago and you had to look up some sort of t-stat and f-value and something called a p-value. And anyway, a lot of that is already done for you these days. Most people don't really bother with that kind of under the hood stuff. But the point is that this is giving you a statistical value, and that comes into here, and ultimately this is one number as well. And this number quantifies the uncertainty about the range of what this future stock value is going to be. And then likewise, the same thing is happening on the right-hand side over here when we look at the strike price. The strike price doesn't change for an option, but we're accounting for uncertainty in what the underlying is going to end up at relative to the strike price using the standard deviation of the option. But it's the same idea. We're just quantifying uncertainty using some assumptions about normal distribution and the volatility of the stock. Now, one thing that's important to know is that this, in the formula, theoretically what this is the expected volatility of the stock for the duration of the option. And so it's like the estimate of future volatility for at least as long as this option is going to be around, time t here. And that's important to make that distinction because we don't actually know what the future risk of this stock is going to be. And in practice, often what we do is we estimate what that future risk will be by looking at historical volatility. We look at what the stock has done in the past in terms of the range of its likely outcomes, and we basically plug that historical volatility into this Black-Scholes model. Everything else you see in this model, you can actually observe, and it's factual, it's accurate. I mean, you can see right now what the stock price is. You can see right now what the strike price is for this particular call option. Same thing with the put. You know the time to expiration, and you actually know R too, because R over the duration of time t, the risk-free rate, very easy to just go and look online to see what treasury rates are. So everything in these formulas are known to you except for volatility, which you have to estimate, oftentimes looking back at the historical volatility of this stock. So that actually matters because in the Black-Scholes model, the one unknown factor is volatility. And we can actually use that to our advantage. We can actually use Black-Scholes, the Black-Scholes model to forecast what people are thinking for the future risk of this stock. We can actually forecast future volatility using the Black-Scholes model. And the way we do that is by looking at the call prices today and the put prices today on a particular stock. If we do that, the premium might say be $5 and $3 for these two. For a particular strike, and we know what the strike is, we just plug everything in. We know what the underlying is, the price of the stock today, whatever it is. The strike for this option might be a $45 strike price. And we know the discount rate too. Might be, say, 2% per year. And just for the duration of this. So basically, we plug everything in. We take a look at what trading prices are. We know what that is. We know what this is. We know what this... Hang on. We may not know what this is. Let's come back to that. We know what this is. We know what this is. So we have these two to solve for. If we look at that, we know what this is. This is. This is. We know how long the option is till expiration date. And so you see in this model, there's only one thing to solve for. And that's volatility. We can, in other words, back out volatility by looking at option prices today. And that measure of volatility is called the implied volatility. It's the volatility that market participants expect for this particular stock as implied by the option prices. Remember, there's this relationship between option prices and volatility. If volatility is high, option prices are more expensive because the higher the volatility, the greater the range of outcomes. And with options, you only get to enjoy the upside. You don't have to experience the downside. So higher volatility means a more expensive option. We look at the prices of the option to back out volatility. And not only is this implied volatility an estimate of the market participant's expectation for the risk of the stock, at least for the duration and time to expiration for the option that you're looking at, it's also a standardized measure of pricing for the option. Because what you're doing is you're inserting underlying, strike, time to maturity, all these things you're controlling for when you plug them into the formula, and you're putting in the price of the call and the price of the put. By backing out the standard deviation in this way, getting an implied standard deviation based on market prices, and simultaneously controlling for things like differences in strike price between the options and differences in time to maturity, you're getting a measure of how expensive or cheap one option is versus another on the same underlying. The same underlying will have a number of strikes. Apple, for example, may have at any given time more than 50,000 different options you can buy. Calls, puts, across a number of different strikes and across a number of different expiration dates. And by looking at the implied volatility of all of these different options, just for a single security like Apple, you can figure out which option is more expensive and which options tend to be are looking more cheap. So it's a standardized measure of pricing for an option, implied volatility. And one way to look at that standardized measure of pricing across all these different options for a single security is called an implied volatility surface. What this does is plot the implied volatility on the y-axis, the vertical here, and plots on one axis the range of strike prices for a single stock or whatever this option is written on. You can have options written on things other than stocks, such as interest rates or currencies. But on one axis here, the x-axis, say the strikes are plotted, And on the other axis, the z-axis, you have time to maturity. So it's a way to visualize all the different options on a single underlying across a range of strikes and time to maturity. It's a way to visualize the implied volatility across all of these different selections. And it's called a surface because while theoretically, because this is a standardized measure of looking at option prices, it controls for factors and with respect to strike and time to maturity, an implied volatility surface should kind of look like this. No, after controlling for these factors, no one option on the same underlying should be more expensive or less expensive than another. But in practice, you get a volatility surface that is uneven. It may look like this, or it depends. It really depends. And this uneven volatility surface tends to tell you which options for this underlying tend to be more expensive, here with high implied volatility, and which options tend to be cheaper, here with low implied volatility. And like anything in life, I mean, sometimes things are cheap for a reason, sometimes things are expensive for a reason. So it's not always the case that, you buy low here and sell high and you earn the spread and it's an instant and guaranteed profit. But looking at an implied volatility surface can more often than not tell you about which options are overpriced and which ones are underpriced, which ones are a better value and which ones are not.